What, in your opinion, is that biggest mistake retail investors are doing in India today?
The two mistakes that I have seen is too many funds, too many products, and the second is
In the light of US tariff, what's your view how Indian markets will get impacted?
most people in the fund management community are very clear that as far as India is concerned, suppose tariffs happen, textiles will be worst affected. Textile stocks did really well because suddenly somebody's realized all our biggest competitors on textiles have got significantly more tariffs. I think staying invested for the long term is the most powerful. In terms of errors or mistakes you can make, choosing the wrong fund category, choosing the wrong fund, all of that frankly gets compensated by time.
Hi everyone, welcome to another episode of Power Talks. Today we have with us Anthony Heredia, the CEO of Mahindra Manulife Mutual Funds, who is also the Vice Chairman of Association of Mutual Funds in India. So Anthony, as someone who is involved in mutual fund industry for so long and at a very grassroots level, what in your opinion is that biggest mistake that retail investors are doing in India today?
I think retail investors still like to buy new things, so they end up buying too many funds. That's sometimes one mistake I think that then happens. The second is, I think at the first sight of panic, they start to look at their portfolio and start to think about what they should do. And you often find that if you had, for whatever reason, gone on a holiday, you're much better off because you didn't have the time to look at your portfolio, you didn't do anything, and pretty much the market then took care of whatever volatility that it had to take care of. So I would say the two mistakes that I have seen is too many funds, too many products, and the second is perhaps over analysis, which, as you know, popularly they say analysis paralysis.
Right, and correctly said, right? So in March, when the small caps and mid cap took a nosedive, the SIP stoppage ratio was the highest, and because as you said, right, all of us sort of panic to stop the SIPs and see
Correct.
what happens. So what's your view on, as a retail investor in volatile times like these, what should a retail investor do?
I'm going to step back and just put a very basic framework around how I have seen people make money. See, in our business, sometimes it is useful to complicate things because it kind of seems like it's a great service. There are lots of complicated and complex services we are providing, but essentially, how do you create wealth? You create wealth by investing when valuations are in your favor, which means when markets are relatively cheap. You invest for a long period of time and you don't over diversify. You stay convinced on a few stocks, a few funds, a few ideas, and allow that to play out. So that's the basic framework. As long as you do that, you make money and wealth gets created. SIP, to my mind, is perhaps the biggest route that people have used in the past and should use to put all of these things into play. And therefore, you are averaging out your cost of acquisition. That's point number one. Point number two, because you're doing SIP and it happens pretty automatically once you've signed up for it, it tends to be more longer term than the average investment, right? If I had 10,000 rupees, I put the 10,000 rupees and every 3 or 6 months the market does something. I have a heart attack and I start reviewing and analyzing and paralyzing, as I said. If it's an SIP and I've put an SIP of 500 or 1,000, I'm not stopping to think, by the time you just think about every morning you wake up, there will be some message from your bank saying your Netflix subscription ka monthly has happened, your mobile phone ka auto pay has happened. You don't react to that, right? You don't say, oh, I didn't want to pay my mobile bill. And the same thing happens with an SIP installment, it just happens automatically. So the fact that you keep investing through that journey happens. And the third is that because SIPs tend to accumulate over a period of time, your sense of long term is kind of 5 and 10 years, because that's only when it becomes sizable, right? It's not like you put 1,000 rupees every month and then after 1 year it's changed your life. So to me, that's what SIPs are, and that's why people should use that as a primary form of investing. Now, why do we see SIPs or the conversation around SIPs discontinuing? Let me just put a slightly different argument. I'll just wear an AMFI hat for a moment. People are distinguishing SIPs. There could be somebody who's discontinuing SIP that they just started 6 months ago. There could be somebody who's discontinuing SIP that they started 7 years ago. to my mind, if you put both of them in the same bucket and saying that X number of people discontinued the SIP is not really accurate, because someone who started an SIP 7 or 8 years ago may have decided that they've reached their goal. They may have come to the conclusion that they need to switch the funds in which they start a new SIP, right? And so, to my mind, as long as the number of new SIPs being opened is not materially different from the SIPs being discontinued, I think we are okay. The last point is that if you look at even normal flows, right, the 10,000 rupee I talked about, even that has come down, because obviously when markets are volatile, people think twice about investing. So I don't think it's unusual. The trend of SIP discontinuation having gone up is equal to the trend of flows which are lump sum coming down. It would be a problem if flows in lump sum were going up and SIP discontinuations were also going up. It just doesn't make sense. But I think the two trends are pretty much congruent to each other. So I wouldn't worry too much about it.
Got it. Got it. And in light of what you said, right, when markets are usually down, thoda, it does get affected. At the same time, as SEBI is also introducing the 250 minimum ticket size per SIP, do you think it will still have the same positive impact that it is expected to be?
So you're asking a question which is very close to my heart. I've personally worked on that project more than a lot of other people, because I'll tell you a little story first.
Yeah.
Okay. About close to 25 years ago, a colleague of mine was applying for a scholarship which the British government gives to Commonwealth students to go and study in the UK, completely sponsored for 3 to 6 months, to think about working on a project that impacted the lives of common citizens. And I remember us going to our boss, because you have to have a letter of recommendation. Our boss was a Britisher who had actually served in the army for many years and then moved to asset management, and he wrote a letter of recommendation. I'm not joking. When my colleague and I read that letter, we were not sure whether we worked in the same industry he described we were working in. Because he said that really what you have been given a chance to do when you're working in the world of mutual funds is to actually impact lives. So it's actually social service if you do it the right way. And that's a thought, and that's a story, a real story that stayed for me all through. And so when the opportunity came to participate in discussions, I just said to myself, just think about it this way, right? There's this old saying, money makes money. So somebody who's worth 20 crores invests, and that person becomes worth 50 crores and 100 crores. Has your life changed because you're worth 50 crores or 100 crores? Arguably not. But a common person who just about saves 20,000 a year, 50,000 a year, they invested in equity over 5 and 10 years, that becomes 3 and 5 lakhs. Is that materially very different to that person's life? Would the wedding of that person's child be very different if that had happened? I would say definitely yes, right? Would you feel very happy and proud as an asset manager if you impacted people's lives like this? The answer is yes. To me, 250 SIP or Choti SIP as it's called is that route, right? Which is that somebody who can't really afford to invest at 10,000, 20,000, but probably can afford to invest at 250 rupees, thinking about maybe it's one less meal I take the family out to the nearby Darshini or Udupi or wherever you typically do. And then over 3 or 5 years, it becomes a sum of money that meaningfully changes that life. Because whether that person's child wants to study in the 11th and 12th in an engineering college, preparing for that, you look at the fees and you think to yourself, that's not for me. To me, when you invest in Choti SIP, maybe that gives that opportunity, right? I spoke about marriage. I could go on and on. So using the world of mutual funds to actually impact people of India in the best way possible is, I think, what Choti SIP has the potential to do.
Great. Thanks, Anthony, for sharing that story. And that's why I love talking to industry experts, because we actually get to know what was the story and context behind, the policies that we see today. So thanks for sharing that. So when we talk about Choti SIP and primarily, the life-changing money that they can create for someone in tier 2, tier 3, equally important is educating them about mutual fund industry. And when I speak for myself, living in a tier 1 city, I am primarily more aware about mutual funds, equity. I am an equity investor myself, equity mutual fund investor. What is AMFI's view on sort of separating the information from misinformation? SEBI has cracked down on Finfluencers with the stock tips wala thing. What's your view on spreading information regarding mutual funds?
So I think there is a clear role, and I know my colleagues in the industry body share that view, that we need to spend a lot more effort on and resources in putting down information in the same media that they are using. So we've typically done television, we've done print, but actually using much more of social media to spread messaging. And secondly, I think keeping it very simple and hopefully proving to people that we don't have a hidden agenda. What I've also seen sometimes in social media is that if you look to counter it too much, you will get trolls and you will eventually lose the battle, right? Because if you have somebody with an agenda to shout you down, and you are a responsible organization, there is only so much, you don't go down to people's level to make a point, right? Like I said, you have to just make sure you are consistent with the effort. As long as you're consistent with the effort, and trust me, the MFSIA campaign or the AMFI initiative has serious resources behind it, and it has had it for many years. It will have it for many more years. So my hope is that we will outlast the trolls. But there's no magic pill. There's no magic pill for us to be able to call out someone and say, hang on, we think that what you're saying has a vested interest. Because people will argue about, somebody who argues that passive is great. Right? That person has a bias. Now you could argue that why you saying this, but that person has an individual perspective. It's freedom of speech beyond a point, right? So our job then is to just make sure people understand the various nuances. There are products, all of them are good. You don't have to call somebody bad to show up as good. If I provide enough content, there is no need for someone to seek it otherwise. I would say be our best approach.
Got it. And just on that, right, slightly controversial, but very curious to know. You said about hidden agenda, right? And I think a lot of this in the stock parlance also came when influencers were themselves invested in certain stocks and they were giving those tips. Sort of similar thing happens, I would say, when your commissions are linked to the certain funds and then you are trying to sell those funds. What's your view on that?
So by and large, I would say that people say this a lot, but I believe end of the day, the time in the market matters, right? So even if you have bought a fund where the person had an agenda of commission, as long as it was a decent product and you held it over time, it will make money. But from a industry body perspective, there is no such agenda, right? I mean, for us, it doesn't matter which diversified fund the customer buys, which is why I think we need to step in a lot more to make sure that the primary consumer looks at our content first and mostly, then look at other people to figure out what they should do.
Right. So it's primarily the industry-driven content.
Because we don't have an agenda to tell you to buy mutual funds. When you step into my shoes as what I do as a day job, I do have an agenda to tell you that Mahindra Manulife is a great fund house. It has great funds. But at an industry level, when we are running the mutual fund SIA campaign, our only interest is customers should know about mutual funds. They should have reasonable amount of trust and they should buy a mutual fund and hold it for long term. There is no more agenda.
Right. And that's what mutual funds SIA did, like at a great scale.
Exactly.
And that sort of, I think now mutual fund SIA se kaun sa wala sahi hai pe already there's been a movement. So that's a good sign. And, I think given the rise of retail participation happened post-COVID, we have all seen that euphoria of bull markets, and now is the test of time.
Correct.
Actually, which will sort of make us believe that equity is for the long term.
Correct.
So what's your view on retail participation going and standing this time? Because right now the earlier sign, like the latest signs show that people are redeeming their mutual funds. What's your view? Will this continue?
So I would say this, if I read or consume Twitter, then it seems like more people are redeeming than people are investing, right? So social media seems to indicate that that is what retail investors do. But hard facts are indicating the opposite, because if that was true, then in the month of January or February, the net flows into the mutual fund industry should have been negative. The 26,000 crores of SIP should have become 20. But instead, 26 has remained 26. The flows have obviously maybe dropped from 45,000 to 25,000, but 25,000 crores, right? This is not 25 rupees. To my mind, I think retail investors are actually doing more often than not the right thing, or let me put it different. Many more retail investors are doing the right thing than retail investors who are not. My message to retail investors is don't fall for the line that you don't know enough. I think a lot of retail investors have become very smart. They're doing the right thing, keeping SIPs going, keeping patience, not panicking because portfolios have dropped 20%. It's that kind of understanding that creates wealth.
Right. And, I as a retail investor, I think I have also not stopped my SIP. But there's always this FOMO of, am I doing the right thing? And especially when markets are all green, you don't question. But when they are not, is when you start questioning. So particularly in today's, and in the light of US tariffs, what's your opinion on, as a retail investor, should we be worried? Will it impact our mutual funds in long term and even in short term? Like, what's your view how Indian markets will get impacted?
So I always say this to people that if I was to answer such questions, I will be a big liar. Because honestly, I don't think anybody can ever predict, even aside from today's times when there is tariffs and all of this stuff. Nobody is ever able to predict what markets will do in the short term, right? You're only able to predict through data, through experience, to understanding that markets over 3 to 5 years will do all right. Let me give you a very simple example. In fact, it's a conversation I had with my own investment team yesterday, and we were just talking about it. Before the April 2nd announcement of Liberation Day, most people in the fund management community or even otherwise were very clear that as far as India is concerned, suppose tariffs happened, textiles will be worst affected, because obviously it's one of our largest exports to the US, right? So many wonderful companies export to the US. They sell in the Macy's and Walmarts, etc. of the world. What happened on April 2nd when tariffs were announced on April 3rd actually? Textile stocks did really well, because suddenly somebody's realized that yes, we have got tariffs, but all our biggest competitors on textiles have got significantly more tariffs. So the textile industries actually benefited from the tariffs from a competitive standpoint rather than hurt. So my point is, these things will keep changing, right? And the idea is that you have a fund manager that understands this and makes the right calls. But even having said that, as a complete disclosure, as far as tariffs are concerned, as far as the current environment is concerned, our at least stance as a fund company has been, let us make sure we focus on all possible scenarios, have all possible plans, and we will react. Let us not predict, because nobody is going to be able to predict, right? I mean, let me give you a cricketing analogy, right? Some of my favorite cricketers, they always talk about, and given that we are in the middle of the IPL, right? What do people talk about in IPL, which is very different from Test cricket and one day, is people have plans, right? So if there's a particular bowler coming in, you have plans. This is the batsman who will come in next. You're making plans for every situation, and based on the situation, you implement the plan that you have instinctively believe will work. So to my mind, on things like tariffs, on things like interest rates, will the Fed cut rates further, will it not? You make plans for every possible scenario, and based on what scenario plays out, you execute that plan. Because as one of my favorite cricketers, Mr. Dhoni, says, it's eventually about executing your plans.
Right.
Right.
What I understand is, as a retail investor, I should not be overly anxious about what's happening, because things will stabilize over time.
Sorry, I'll interrupt. As a retail investor, that's why you should buy a mutual fund. No, because if as a retail investor, you wanted to, instead of considering your day job or the business you're trying to create, you want to analyze tariffs, you want to analyze Fed rate cuts, etc., then you are better advised finding a job in a mutual fund. If you are finding much better joy doing the job you do or creating the business, then leave it to the fund manager. Then you don't need to bother. You just need to wonder about whether you are with the right fund manager and the right fund house. They will deal with it.
So yeah, I want to focus on, of course, I'm invested in mutual funds, but then there's also my portfolio allocation, right? I'm X% in equity. It makes me think, should I reduce my equity exposure, or increase my debt, maybe invest in gold? Because as a retail person, a retail investor, I always think of, am I optimizing returns? Am I sort of losing out an opportunity? So it was more from a equity or a portfolio mix standpoint. So what's your view on that?
So there are many wonderful people, including some Nobel laureates, who have written wonderful pieces on asset allocation being one of the biggest and primary sources of returns over the long term. And I think they're all reasonably accurate based on my own experience. But when I started off, somebody explained to me one very simple rule, which is that you minus your actual age from 100, and that's what you should do in risk assets. I'm not just saying equity, right? Risk assets, because in many of your audience, crypto is a risk asset, right? Equity is also a risk asset. Playing Dream 11 also is a risk asset. In some sense, I would believe that you have the right mix based on that formula in equity, fixed income, gold, number one. More importantly, I would say you should have emotional control to not, when you go out and meet your friends and somebody says, I invested in this equity product and I got so much return, for you to go and next morning go and invest more in equity than you should have. You should just have the वो FOMO feeling. Agar if you can deal with it, that FOMO does not affect you, you will be very peaceful. So asset allocation definitely matters. If people say that, oh, you're 25 or you're 30, what care do you have? You should have 100% in equity. And my answer is that absolutely no. Because if I would combine two things, how can I invest to create wealth for myself over a long period of time in a manner that when I go to sleep, I'm able to sleep peacefully. And if you want both together, then you will have to follow some sense of asset allocation, because the day equity gives you a little bit of heartburn, the fixed income and the gold portion will give you a bit of comfort. You'll still go to sleep. Right? On the day that fixed income rates have fallen, etc., equity may be a nice comforting thing.
Since we are talking about portfolio allocation, would love to understand, you manage thousands of crores of AUM. What's your portfolio allocation like?
In spirit of full disclosure, if I followed most of my advice across the 30 years or so of my working and investing journey, I would be a lot wealthier than I am today. So first disclosure is, I myself, I think, spent at least 10-15 years doing exactly what all retail investors do, right?
Our
It's see, because it's very easy. There's a saying, right? Practice what you preach, but it's much easier to preach. A lot tougher to practice. But coming to the specific question, my inclination is that typically my intention is to have anything between 60 to 75% in equity. I think I have a reasonable corpus which allows me to stretch beyond, because given that 100 wala example I told you, I should logically be at 40-50% equity. I know I'm telling you my age as a consequence, but I'm just saying I feel comfortable enough to do 60-70% in equity. I am a believer that gold should be 5-10% of everybody's portfolio. Gold, silver, whatever. I think fixed income, I'm just going to introduce a topic for your audience. Please look at REITs. It's a new asset class which has come in, because today's younger generation that is going to invest through you, like my generation, we cannot invest 10 lakh rupees and buy a house, which I could have done, right? Today, 10 lakh rupees is not going to buy you a room. But you could invest in a real estate investment trust and own a piece of real estate, because given our country's growth, etc., real estate, etc., will do well. So I would say a combination of that. So I have REITs.
Okay.
I have a bit of fixed income, but it's principally, I simplify my life. I only think about where I am in terms of my equity allocation and whether I should adjust it upwards or downwards. The rest I don't do too much time pass. Also, this may sound illogical, but I've always found in my experience, if you invest into a asset class or a product in the early part of its journey, tends to end better.
Okay.
Right? Because effectively more people will find the joy in REITs, more REITs will get issued, liquidity will improve, price discovery will improve, etc., etc. So my cheat code on that is that I think things like REITs at a larger level, infrastructure trusts as well, but let's stick to REITs for a moment. 5 years from now or 10 years from now will become a reasonably common investment for someone to do for income.
Okay.
And so to me, starting into REITs now is I would say intuitively a smart thing to do, because investing in something that's going to turn out to be a very relevant thing in times to come should not hurt.
Got it. And since you pegged it or sort of compared it with fixed income, so is the risk also of the similar, like it would be slightly more risky?
It's slightly more risky, but honestly, I peg the risk at again related to equity. Let's assume we had this conversation 6 months ago when markets in September, October, right? Where markets were where they were.
Yeah.
And I'm thinking where the markets are valuations, what is my expectation from equity over the next 1, 3, 5 years? 12, 13%. Given market valuations, given what you're seeing, what's the risk of it not happening? Pretty high. On the other hand, you are saying that this is the peak of interest rates, will start falling. So I'm probably going to get 7.5%, 8% from just a bank FD in a very solid bank. What's the risk of that not happening? Very, very little. For the delta of 4%, what is the extra risk? Or I like to define risk as ability to sleep. Maybe not worth it, right? So for me, fixed income, I don't overthink. बिकॉज वैसे भी हम लोग इक्विटी पे इतना ओवर थिंकिंग करते हैं, अभी आप फिक्स्ड इनकम पे भी ओवर थिंकिंग करोगे.
Got it. And within equity, right, I think that analysis paralysis, because 4,000 mutual fund schemes hai, multiple 20 plus categories hai. Is there any framework that you would recommend to our audience how to look at, dividing the equity portfolio within the different categories as well, mutual fund categories?
I genuinely believe it, that we have too many funds, too many schemes, too many types. As long as you buy 4 to 5 different types of funds which are all diversified, so one large cap, one large and mid cap, and a couple of flexi cap and multi cap funds from 3 to 4 fund companies, so therefore you have totally 10 to 15 funds from 3 to 4. That is good enough for your entire equity portfolio, to my mind, for your life. Because when you look at any data point over 5 to 10 years, all these other subcategories eventually revert to mean. I'll give you an example, because I actually had a lecture I was giving a group of about 300 seasoned financial advisors 2-3 months ago. The topic was long-term investing and how should one practice the advisory profession. And I was like, how am I going to meet 300 people who've heard the same old typical, time and not timing matters, etc. So I sat at my desk and I started saying, okay, suppose we talk fund selection, different types of funds important. Suppose I am absolutely not capable. I invested 10,000 rupees in every fund that existed 10 years ago. No selection at all, whether it's a large cap fund, whether it is Mahindra, Manulife, whether it is somebody else, nothing. I just invested. If there was a fund, I invested. What is the net return I got after 10 years? There were 8 fund type of equity categories that had 10-year history.
Okay.
I realized that my strategy came in after 10 years at number 3. Invest for the long term. Don't analyze your portfolio every 6 months. You will be very happy, is my simple submission.
And I think that's very clear and, very actionable takeaway. Don't overthink. I think that's
Yes.
That's very much required. One category that you didn't mention, and you actually mentioned it as a mistake that people do, is buying flavor of the season, and it's usually the thematic funds. And last year was in fact, last 2-3 years have been examples of whatever was rising. returns wise. AUM was chasing that. What's your view on retail participation increasing in sectoral like anything? And where are we headed towards?
So let's think about this. What are the typical popular sectoral funds that we've seen? Let's say not just in this cycle, over the last few cycles, right? So I am an investor who's happy to buy flavor of the moment. So now I have an infrastructure fund, I have a manufacturing fund, I have an innovation fund, I have a defense fund, I have a banking and financial services fund, I have a pharma fund. Effectively, I open a diversified fund. It has all these six sectors. So all I have done is more often than not bought into the flavor of the moment, which means those sectors have already done well. Instead of buying a diversified fund, which would have bought those sectors when they were not doing so well, right? So my advice to people is buy an NFO if it genuinely represents a fresh, new, diversified idea, and it comes from a fund company that is not part of your portfolio that you're beginning to like. If neither of the two are answered, stick to an existing fund. NFOs do not have a birthright to outperform regular funds by any stretch of imagination. The only time, and I can tell you, I posted this on my LinkedIn when we did our last NFO in February, right? So it was a very challenging time, and I said, I have only with NFOs come to one realization. When an NFO struggles to get money, I have always found that NFO has done very well for investors over time. When an NFO is flavor of the month, everybody's telling you to buy, your cousin, your neighbor, your friend, it never ends up well. That's my only answer.
Right, because you're chasing someone else's like returns. वो तो बन चुके हैं already.
You're chasing, like I said, it may sound cliched. When you are doing NFO, you are doing Instagram reel. When you're buying diversified funds for the long term, you're doing feature film. And obviously, I'm assuming your audience is from across the country. But let me, since we are in Mumbai, discover, Bollywood may, there is at least, by and large, one good thing about a Bollywood movie is that there is a happy ending.
Yeah.
Right? The movie is long, but there is a happy ending. I would argue in equity the two are correlated. If your investment time frame is long, there will be a happy ending.
Right.
Right. So to my mind, that's the same thing with NFOs versus, you want to bring excitement, want to do the Insta reel, do NFOs. But remember, your Insta reel will disappear off somebody's timeline in a day.
Right.
People still watch Sholay.
No, fair point. And I think perfect note. Just last final question, Anthony. Or like, what's your recommendation? What's your advice to a 30-year-old watching this video? How do they sort of stay invested? How do they invest to get their happy ending?
I don't think what I tell people today, I didn't do as a 30-year-old. It is boring advice. Just invest in diversified funds regularly, stay invested. Of all the things I spoke about, I think staying invested for the long term is the most powerful. So message I would give to a 30-year-old is actually in terms of errors or mistakes you can make, choosing maybe the wrong fund category, choosing the wrong fund, all of that frankly gets compensated by time. The other is not true. If I invest only for 2 years, and I picked the best fund that turned out in those 2 years, when I'm 45, I'll realize that I clearly should never have taken that money out after 2 years. But instead, suppose let's put it this way, we're in 2025, 2010, even 2010, I came to the conclusion that buying a small cap fund was easily the best thing to do of this fund company. And had I invested 1 lakh rupees, it would have been worth X. The reality is that had I bought any equity fund at that same day, it would have at best been 90% of X. So, and if X is meaningful, 90% of X will also make me happy.
Fair. I think you rightly said it. Good investing is always boring. So just staying the course is the key thing.
And like I said, it's about giving it time, and that it sounds very simple. To me, that's the biggest challenge. That how can somebody, you look at data, average holding period of Indian investors has only now crossed 2 years. Right, in all this conversation we discuss 5 years and 10 years, but it's 2 years, right?
Yeah.
So if you find a way for you to hack time, you're sorted.
Right. Perfect. I think perfect note to end this conversation, Anthony. Thank you so much for taking out the time. I had a lovely time.